The growth is very impressive relative to the valuation. You know, back in 2000, in that tech bubble, Cisco was 100 times earnings. You know, Google up until today, yesterday, whatever, after today, before today's rise, was 21 times our earnings estimate. And considering growth that they're achieving, is very reasonably priced. So it's a simple fortress balance sheet, dominant industry position, growing very rapidly, very reasonable multiple. It's about 5%, 6% of our fund.
Yeah, Jim, you know what? Maybe Google is just simply tired of everybody talking about Amazon and Facebook. They wave over here and say, don't forget about us. Stock up 50
we
bucks.
We own Facebook and we own Amazon too.
Yeah, no, I know you do. I know you do. I'll get your thoughts on those in just a second too. Jimmy?
I think that's absolutely appropriate. I mean, they're looking at this and saying we've got, what, a 24 times forward multiple on estimates that are probably going to go up. And to Lee's point about the price that you pay, you know, the PEG ratio on this is 1.65. That number is actually going to come low. You compare that to some of the NASDAQ high flyers. You mentioned Amazon, Scott. You know, those PEG ratios are well over 5, 6, 7. So, yeah, I think they do have to wonder why they don't get any respect. And maybe it's that people say, well, it's already so big. How could it get bigger? Guess what? They put up 23% revenue growth on over $100 billion of sales. So they've grown more than $25 billion in incremental sales over the last year. If you were just a standalone company, that would be fabulous. They deserve more respect than they get.
Yeah, Joe? $1,260 as we speak.
Yeah, well, this goes back to the conversation we had yesterday when we talked about, is it trade or is it earnings that ultimately matter? And again, it is earnings, and your evidence to that is this morning. We came in this morning with, I thought, some surprisingly good global asset trading. Europe, you had banks and car makers higher, which is something we haven't seen. Shanghai Composite, the last 3 days, that's the biggest rally that we've had in the last 2 years. You got the news from the Chinese that they're going to have some infrastructure spending, so that's a little bit more of an easier monetary policy. So we had this consortium of good information coming in, and then you add upon that the ability to focus on earnings, which is what we should be doing right now. And I would argue the market responds, or appears to be responding, much better to favorable news than negative news over the last couple of weeks.
If I can just point one thing out, you're right, but there are little chinks in the armor here. You look at Whirlpool today, just as an example of, it's a small number where trade is having an effect and the tariffs are really hurting them. You see the stock, I think it's down 13% last I saw. Tariffs on metals, that's basically their raw material. It's their major raw material. It's hurting them.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.